minutes, and you can have questions and answers at the end of the seminar if you would like to do that. There's also going to be a recording on YouTube afterwards if you want to share it with colleagues who weren't able to attend. Or you can contact me directly after the seminar if you've got any particular questions. Just to let you know who I am, my name's Sarah. I'm a share scheme solicitor. I've been working in the field of share plans for about 20 years, mainly with private companies. My contact details are here in case you want to get into contact with me after the webinar. And I probably should also note that I'm a share scheme solicitor with a cough today, so I might be turning my mute button on from time to time if I have an attack of coughing. So I apologise in advance if that happens. Today we're going to be talking about the Share Incentive Plan, or SIP. It's intended to be a sort of practical outline discussion rather than anything particularly technical. I'll be talking about the key benefits of the scheme and the main requirements and how you can actually set a plan up and administer it. And I'll also run through a quick case study explaining about how one of our clients used the Share Incentive Plan to best effect. So what actually is a Share Incentive Plan? It's a government recognised tax advantage plan. It's been around since 2000, so it's very, very well established. And it's what used to be called a government approved plan, now tax advantage, which is a good name. Oh, I've just been told my screen isn't showing. I beg your pardon. Here we are. That should work. My apologies. So the Share Incentive Plan, as I say, has been set up since 2000. It's extremely well established, and the tax advantages are excellent. So tax advantage is a good name for this plan. It does effectively provide zero tax rates for the participants and for the company, indeed, if it's used correctly. Obviously, there are rules that have to be followed in order for those tax advantages to be obtained. So the SIP has to be made available to all employees in the company, and it does involve actual shares rather than options, shares being held in a trust on behalf of the employees. But within the limits of those rules, actually the scheme is very flexible in the way it works. So it allows shares to be gifted to employees, or it can be bought by them, and it also incorporates a bug-off arrangement, or actually a buy one, get two free arrangement where you can match free shares to partnership shares that are actually bought. The plan's intended to encourage long-term motivation and reward for employees, and the legislation does actually state that it's intended to provide employees with a continuing stake in the company. So if that's your intention, then SIP is really the go-to plan. So I've run through the key benefits, and while it's true that you should never actually implement an employee share scheme purely for the tax advantages, it is undeniable that the SIP is very, very tax efficient. There's no income tax or national insurance contributions to pay when a share is gifted to the employee, and if the employees buy shares, they buy them out of pre-tax salary. And once the employee sells their shares, assuming certain rules are followed, there should be no capital gains tax to pay either. From the company's perspective, no NICs to pay includes employers' NICs as well as employees, so there's a saving for the company too, which can be significant. In addition, there's corporation tax relief for the company, so the company can claim a deduction for the costs of setting up and running the plan, and it can also get a further tax deduction for the market value of free and matching shares that are given to participants under the plan. That's pretty tax efficient for the company on the whole. Furthermore, founders who sell their shares into the SIP can also obtain capital gains tax relief on those sales, again subject to certain rules. So there are a number of significant tax benefits attached to using this plan for employees, for company, and for founders who wish to sell their shares into the trust. The other key benefit of SIP, I think, is the flexibility and choice which it offers. So it allows employees to get their hands on shares in a variety of ways. Firstly, they can be given free shares. They can get up to 3,600 worth of shares each year. That's per employee, per annum, and that's tax and NICs free. They can buy up to £1,800 worth of shares out of their pre-tax salary. Again, each employee can do that each year. and they can receive up to 2 further shares free of charge for each partnership share that they buy. So that's known as a matching share, and that's the buy one get one free. I seem to be having some issues with my setup here because I'm showing my screen, and okay, hopefully that's worked. Sorry. So you can see that there are some significant flexibility benefits around this part, and you can choose which ones you want to do. You could just do free shares, or you could just do partnership shares, or you could do partnership shares in a match, or you could do the whole lot. And if you do the whole lot, that gives you a maximum allowance each year for each participant of £9,000 worth of shares, which they can acquire in a very tax efficient way under the share incentive plan. Another key benefit is that even though this is an all-employee plan, it doesn't mean that owners, particularly of private companies, are necessarily giving up control of their company. So for starters, you can use non-voting shares in a share incentive plan. In addition, do remember that all awards are made in accordance with the company's wishes. So they've got a lot of control. The company has a lot of control over the number of shares that can be acquired by employees. You could, for example, just make a one-off award. You're not obliged to carry on making them each year. You can set a limit on the number of shares to be acquired at each award. In addition, if people leave, you can make sure that the shares don't go with them. So free and matching shares can be forfeited if employees leave within 3 years of the date they acquire the shares. And otherwise, shares can be required to be sold back to the trust by people who cease employment. And then the trust can use those shares for future awards and recycle them. So just because you're setting up an all-employee share scheme doesn't mean that you're going to be giving up control to your employees. You have got a significant amount of control over the way that plan is going to run. I want to talk about some of the key requirements for the share incentive plan, and probably the most important requirement is the need for a specific SIPP trust and indeed the trustees to run it. The trust needs to be UK based, and the reason it's there is it's to hold shares on behalf of all of the employees. So it's not a discretionary trust, unlike some other employee benefit trusts that you might have come across. It has to act in the interests of the beneficiaries, which is again the employees. It's quite common to have an independent professional trustee running a SIPP, especially for larger companies. But there are plenty of smaller companies that use individual trustees, for example, a couple of directors and maybe an employee of the company to act as directors of the trust company, or even an individual trust. So it's perfectly possible to do that. But you do need to SIPP trust, otherwise the plan won't work. And the trust itself does have some advantages, as one of the tax advantages I've already discussed, especially for private companies. It's a really good way of ring fencing a certain proportion of shares for the employees. So once they're in the trust, there they are for all the employees, and they can't usually be used for anybody else apart from employees acquiring shares under the SIPP plan. It enables you to recycle the leavers' shares, as I mentioned earlier. So if somebody's acquired some shares and then they leave, sell them back to the trust, and the trust can make awards of those shares to under future awards under the SIPP. And that's a bit easier really than the rigmarole of buying shares back from leavers and then cancelling them, which is often the case for a private company. If you've got employee shareholders who leave, it's a much easier way of managing it, I think. And it can also be used as a kind of internal market for employees in a private company. And I've got an example of how one of our clients did that later on in the presentation. So those are the advantages of the trust, but the key advantage is that for as long as employees leave their shares in the trust, any gains relating to those shares will be entirely free of capital gains tax. So for employees, there's actually a little advantage of taking their shares out of the trust because that removes the tax shelter. You might as well just leave them there in the safe and capable hands of your professional trustees who will be looking after your interests at all times. Another key requirement is that the SIPP must be offered to all employees in the company. So the main purpose of the plan is actually set out in the legislation. It must be set up to provide employees with a continuing stake in their company. And very importantly, the main purpose, or one of the main purposes of setting up the plan, must not be the avoidance of tax. Irrespective of how tax advantage this plan might be, you do need to have other reasons behind setting it up. As I said, it must be made available to all employees, but note that if you're a group of companies, you can exclude some subsidiary companies. So, for example, if you've got overseas subsidiaries, there'd be no point in making a SIPP award to those overseas people because they wouldn't benefit from the UK tax advantages that are offered under the plan. And crucially, employees must participate on the same terms. So that doesn't necessarily mean you have to give everybody exactly the same number of shares. But you do need to make sure you don't end up with the higher paid employees being the main beneficiaries of the scheme. You can vary the number of free shares according to certain specific measures set out in the legislation, which are salary, hours worked, or length of service. And you've got a financial limit on the partnership shares that can be bought each year anyway, so that's £1,800 per year. So it's going to be hard for employees who are higher paid or directors to benefit disproportionately for using partnership shares anyway. Worth noting that you can set a qualifying period, so you don't need to offer the SIPP awards to people who've been with you for like a week and a half. You can have a qualifying period of up to 12 months to make sure people have been with you for a decent amount of time before they can participate. And it's also worth noting that following fairly recent change in the legislation, majority shareholders can also participate as long as they're employees. There used to be a material interest test in that if you had a certain percentage of shares in the company, you couldn't qualify for SIPP, but that is now being removed. So actually founders can be involved in a SIPP as well if they want to. The last big requirement for share incentive plan is the fact that you need to be aware that it's a long-term plan. Effectively, for the tax benefits to be maximised, the shares have to be held in trust for at least 5 years. In our view and in the view of most share schemes practitioners, that is too long a period. The Chancellor has recently confirmed that he has no intention of reducing that period, unfortunately. So for the time being, we're stuck with it. In my view, it's probably still worthwhile waiting that 5 years because of the zero tax rates that can apply. So you do need to be aware that if you have given shares to employees and the shares are taken out of the trust within a certain period, there may be a clawback of those income tax and national insurance contributions that were kind of awarded free when employees first got their shares. And the amount of clawback will depend on how long the shares are held in trust. So if shares are taken out of the trust within 3 years of the date of the award, then income tax and national insurance will be charged on the market value of the shares at the time they're taken out of the trust. If they're left in the trust for a little bit longer, between 3 and 5 years, it'll be the lower of the two market values, date of award or date taken out. So there's a kind of like tapering arrangement really in terms of the clawback of tax benefits. Having said that, if an employee is a good leaver within the meaning of the legislation, usually retirement, ill health, disability, the sort of typical good leaver provisions, there won't be a clawback. So if an employee really leaves through no fault of their own, then that clawback will be removed. If the company's sold or taken over for cash within the 5-year period, again, there's an escape route for that. And as I said, as long as you leave them there for more than 5 years, those tax charges cannot be clawed back. So how do you set up a share incentive plan? There are some must-haves and some nice-to-haves. I think you definitely need some careful thought about the design of the plan, what you might call a design blueprint. You can't really underestimate the importance of this because you need to think about how much equity you want to use. You need to think about how you're going to be using that flexibility available under the SIPP. Will you be using free shares or partnership shares or matching shares or a mix of the two? Are you going to do different awards at different times? So perhaps start off with free shares to get people interested, and then as people become more interested in the SIPP as time goes on, offer them the opportunity to buy partnership shares in the future. You need to think about how the company will fund the arrangement. So, of course, if employees are buying shares, then they're funding the payment. But if you're going to be offering free shares, you'll usually need sufficient profit reserves in order to dole out those shares. So that's something you do need to think about. And you're probably sensible to put in place a kind of fairly key timetable in terms of setting up the trust, appointing the trustees, opening a bank account, when you're going to be setting out your communications plan. So maybe you start with a teaser to employees going, we're going to be doing this plan and have a think about it and here's some information. And then you kind of launch a fuller communications program closer to the actual launch date, when you're in a position to actually start out handing out invitations to employees. So I think a timetable and a blueprint is quite important before you actually start doing anything. That is the fundamental point underlying the SIP, your decisions and what the company wants to do. You will need a set of plan rules which need to comply with specific tax legislation, and they'll set out how the plan operates and the different types of awards that can be made. You'll need a trust deed, which sets up the trust, which is usually attached or incorporated into the plan rules, and you will need a trustee to operate the trust. So it's the trustee's job to make the share awards to employees and to hold the shares on their behalf and to buy the shares back from them when people leave. Again, the trust needs to act within the rules of the plan and the legislation, and it needs to be aware always of the employee's best interests. And it will also take instructions from the company's directors as to what the company's directors want it to do. So, for example, the directors might resolve to make a free share award to all employees in April, and the trustees will then put that into operation. But if the directors resolve to make an award only to certain key employees, then the trustees can't do that because they'll be operating outside the rules of the plan and the overriding legislation. So it's quite important that the trustee of the SIP has a reasonable understanding of how the plan should work and their duties as trustees of the SIP. And private companies, as I've said, sometimes have individuals acting as trustees, but quite a lot of the time they find it easier to instruct an independent corporate trustee because they know that independent corporate trustee is following the rules correctly. As mentioned, you'll need to set up a bank account for the trust. As I said, the trust will be funded by the company, so it will need money to subscribe for shares in order to make awards for employees, particularly if you're using free shares, as noted previously. And if employees are going to be buying shares, the trust uses their salary contributions to purchase the shares in the company. Approval of shareholders and board resolutions. Well, it's advisable to get shareholders' approval to establish a SIP, and it would normally be the case that you'd have the board of directors holding a resolution or recording a resolution to confirm the plan's been adopted and recording when awards are going to be made and on what basis. And the trustee will need to keep records as well, usually in the form of a board minute if it's a corporate trustee. As to the employees, if and when they decide to participate in the plan, they have to enter into an agreement. So that might be a partnership agreement or a free share agreement. If it's a partnership share agreement, they'll need to agree how much money they want to set aside, whether it's a one-off or on a sort of monthly deduction basis to buy the shares. And the agreements will also contain certain information about, for example, what happens if they cease employment. Will their shares be forfeit? What will the tax treatment be if they leave within a certain period? The employees won't be able to participate unless they enter into those agreements. And so they're the kind of functional documents for the employees. They'll inevitably see the rules as well, but the rules are kind of quite can be quite hefty and frankly quite tedious. So those agreements are very important in terms of the contractual arrangement. Also very important is the employee communications documents or the frequently asked questions, because that will explain, hopefully in fairly plain English, how the plan works, what the company is trying to achieve, and summarise the key points of the plan without it being too technical. You'll also need to agree, if you're a private company, certainly a share valuation agreed with HMRC. You can do that in advance. And once the valuation is agreed with the revenue, it will usually last for 6 months in the case of a share incentive plan. So you get the agreement made and you've got plenty of time to make your awards. And very typically our private company clients will agree a valuation each year and make an award based on that, and then do that every year. So you're kind of minimising the administration, the costs, and you've got a valuation that's updated each year. And I have said you will need, whether this is a nice to have or a need, I think you probably do need a well-organised payroll, especially if you're going to be doing partnership shares. You might also benefit from changes to your articles of association. For example, if you wanted to use non-voting shares, you might want to have some detailed equity modelling to work out exactly how many shares people might acquire into the SIPP, what the tax advantages might be, or the tax outcome, taking into account a certain percentage of leavers. And that modelling exercise can really be as simple or as complex as you want it to be. That's something we help clients with reasonably often. You may want to have an independent trustee or administrator if you feel that running the trust is a bit beyond your directors, or you feel it's more appropriate to have somebody independent running a trust on behalf of employees. And the communications documents, as I've noted before, a detailed communication document can be really helpful, and you can really tailor it to your particular workforce. Some people, like me, like great big long hefty documents to read through. Somebody else might prefer a text saying, okay, you can sign up for your share plan this month. It depends very much on how your workforce operates. So we've had SIPs, for example, when you effectively you'll need to get all the factory floor employees together, and you need to make sure that you have got different times to do the employee communications so that your company doesn't stop working in that time when you're explaining to employees. So it's a matter of thinking. Again, going back to that design blueprint, how are you going to communicate this most effectively to your employees as you set the plan up? Just quickly how it works. This is how it works usually for our schemes. Company sets up the trust. Company invites employees to participate in the trust. To the extent they want to participate, the employees enter into the share agreements and agree the salary deduction if they're going to be buying partnership shares. Then the company issues the shares or the funds to the trust, or the founder can sell. If the founder wants to transfer some of his shares into the trust can buy it from the founder if that's appropriate. Then the trust sits there holding shares on behalf of employees, and it can pay out dividends over time, and it can buy shares back from leavers and use those shares again in future awards if they want to do that. Once the first awards are made, there are bits of administration that need to be carried out. So you need to register the plan with HMRC, with HMRC's lovely online ERS system. You need to submit an annual return for the plan, keep records of leavers and when awards have been made. It's really important with the leavers that you record the reason for leaving and the date they're leaving, because whether or not they're a good leaver will have an impact on their tax treatment. So that's quite important to keep an eye on. And you do need to keep records of your correspondence with HMRC. And a handy tip, if you're going on the online ERS system, which you'll have to if you're running any type of share plan, do take a screenshot of everything you've done, because the system is not always quite as fully functional as it might be. And unless you've got a screenshot saying, I filled in this form on this date at this time, there is no other way of you demonstrating to HMRC that you've carried out your obligations on the returns. So we do screenshots of literally everything while we're dealing with ERS. Company will need to liaise with the trustee as regards to awards, and in respect of the trustee, there will need to be a trust return each year. If it's a corporate trustee, you will obviously need to do company's house returns and so on and so forth. And at all times, that trustee must act in accordance with its powers and duties and in the interests of the beneficiaries throughout. So once the plan's up and running, there are certain things to kind of carry on and keep on top of. And that's why some of our clients find it helpful to use a professional trustee, because they will take account of all those bits and pieces which otherwise can get missed. I wanted to just really quickly run through a case study. I've got a few minutes to do this, of a private client of ours which used SIPP to achieve a number of things, really. So this particular company was a company wholly owned by a family. And I didn't really want to sell the company. They were thinking vaguely about succession. They were really interested in getting a decent level of commitment and loyalty across the whole workforce. and they wanted a clear economic benefit for the participants. So they wanted them to get some money out of any shares. Also, they wanted to retain a significant interest for the Heron family and all the little Heron children. So they set up a share incentive plan and a SIP trust, and they started awarding free shares to their employees, which is based on a points-based system, a mix of length of service and salary. When people left, they recycled the shares through the SIP trust, and they also let employees sell their shares back to the SIP as and when they wish to. So over time, this is basically the way it works. So Mr. Heron sold shares into the SIP trust, so his interest in the company was reduced, and the SIP's interest was increased, and the SIP gave free shares to the employees and bought it back from employees if and when they required them, and also sold the if people left, or if people left, they would sell their shares back to the share incentive as well. So the employees and the SIP interests were increased over time. It wasn't a very big company, it was only about 45 people, but it worked for around about 7 years. I think we had free shares made each year. We agreed valuations with SIP each year. So if SIP shares were bought back, they would be bought back at that valuation previously agreed. There was also an EBT running alongside, which was used to grant discretionary options to employees. And again, the EBT would buy shares back from those employees who'd acquired shares under the EMI. Sometimes the SIP would buy them back, in which case those shares bought back from what would be a discretionary employee were then ring-fenced for all of the employees, and they couldn't be used on a discretionary basis. And everybody got dividends, and everything was going along tickingly. And then Mr. Heron got an offer he couldn't really refuse, and the company was actually sold last year. And at the sale, Mr. Heron's interests and the interests of the Heron children had been reduced, although the children still had a significant interest, and the employees ended up with the best part of 20% in the company by way of the SIP and or the EMI. So the outcome for the Herons was that they achieved exactly what they wanted to do. They kept some key directors. The SIP employees had capital gains tax-free sales when the company was sold. The owner had transferred enough of his shareholding that he wanted to do. He was really keen on retaining staff, and the staff were retained. His view was that the plan had really worked in terms of long-term retention of staff, partly because of the economic benefits they'd seen, whether by a receipt of dividends, which were paid regularly, or by the very fact that even though it was a private company, they could sell their shares if they wanted to back to the SIP and see an economic benefit there. So his vision of a kind of wider ownership and company culture and reward based on share ownership was achieved, and he was a very happy client, and that made us happy as well, because that, I think, is what a SIP is all about. In a way, it's a bit sad the company was sold, but everybody was happy with that outcome as well. So I'm about at the end. So just to conclude, I think if you want all employee ownership without necessarily the sort of John Lewis or employee control, SIP is really your go-to scheme. It's a really good way of creating a long-term share ownership culture on an equitable basis for all of your employees. It's insanely tax efficient as long as you're prepared to deal with that 5-year period that we mentioned. And it's very, very flexible. So you can give shares, let people buy shares, and mix and match the way the plan works to your particular requirements. That's the end of the webinar. I think we send up a survey from SurveyMonkey. It'd be really nice if you filled that in so that we can make sure our webinars are useful for the future. If you have got any questions, do follow up by email. I'm just checking to see if we've got any questions coming in. I can't see any. It may be that you don't have any. But if you do want to ask me something afterwards, there's my telephone number, there's my email address, and we would be more than happy to speak to you about a share incentive plan for you or for your clients if you thought that would be useful. So I'm about to wind up. It's I think it's about at 11:30. So thank you ever so much for attending. Oh, I've got one question. will you be sending participants a copy of the slides? The slides will be available on our website. We'll be posting them this afternoon. And I can probably send you a copy of slides. If you send me your email, I think I can probably do that. But we'll send around a link later to say that say where the link is on the website, and you can have a look at that. One thing I have mentioned is that this isn't always appropriate for private companies to sit, but you can have a portal for your share incentive plan, an online portal for your employees, so they can see how many shares they've got and hopefully what the value is at the time. That's obviously more important for a listed company because the share price moves a lot more, but it's becoming more and more of a requirement for private companies as well, and it can really make people feel more involved if they can go onto a portal and see what shares they've got and be able to sell them easily. So that's something we can help with, not just for listed companies, but for private companies as well. So can't see any other questions coming in. Thank you. Thank you very much for saying thank you on my questions. Thank you all. I hope you found it useful. Do please get in touch, and thank you for listening.